Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 29, we're going to talk about installment sales to a trust. Now before we can get into why you might want to do this or what the benefits might be, we'll first look at installment sales in general and then cover some of the nuances that come up when you make an installment sale of an asset to a trust. Now, as always, this presentation is not intended to substitute for legal or tax advice. So, installment sales in general are intended to recognize that when you sell or exchange property, the positive difference between the basis of what you gave away and the value of what you receive in exchange could be subject to income tax. And that positive difference is what's known as your gain. And really what that does is it reflects the gain in value of that property that accrued during the time that you owned that property. Now, in terms of the buyer, they may pay you cash in a lump sum, either that they have or that they borrow, but sometimes if the credit worthiness is there, you may be willing to let the borrower or the buyer pay you back over time in installments. Now the problem is that you have all this gain on the sale, but you don't have cash to pay the tax on that gain immediately. Instead, that cash is going to be paid over time. But what the IRS allows you to do is spread out the gain over time to correspond to each installment. So for example, if you're receiving 10 payments over time, equal payments, you could just recognize 10% of the gain for each of those payments. Otherwise, without these rules, the installment obligation itself, which is usually a promissory note, could be treated as an asset received in exchange for the sold property, which would require all gain to be taxed in the year of sale. That creates a problem known as phantom income, where you have income you're taxed on, but for which you haven't yet received cash. Now, when it comes to trusts, there are several estate planning techniques that involve the sale of assets to trusts for various purposes. And one of the principles around that recognizes that whenever a grantor transfers property to a trust, it's either a gift or a sale, but it could be both gift and sale, depending on a comparison of the value of what's been given away to the value of what is received. So, if you're going to sell an asset to a trust, usually it's done in a way to avoid the application of gift tax, so that if the IRS doesn't come back and say that you should have used some of your gift tax exemption or anything like that. Now, in a pure sale type of transaction, it's important to note that you need to have a very good substantiation and estimate of what the value is of the property you're selling to the trust, maybe in exchange for an installment obligation, because if the IRS says that the property was undervalued, they could come back and claim that there was a gift, and maybe since you're entitled to receive payments from the trust, that could cause the trust to be included in your gross estate for estate tax purposes. So valuation is very important if you're going to try to avoid gift tax here. But the overall benefit is that since we're making this sale, in this case to a grantor trust, the trust itself is disregarded. That means there's no gain or loss on the sale to you or income from the interest on the payments back to you because the grantor trust is disregarded. So what that recognizes, once again, is that you can't be taxed on a sale of assets to yourself or on the payment of interest to yourself. But it's important to note that the sold property must also generate enough income to pay the interest and principal installments to you. Otherwise, the IRS could come back and claim that this was, in essence, a gift and not a sale. And it's also important to note that that income will be taxable to you as the grantor of the trust. I've seen taxpayers get into trouble with this before when they try to sneak around that taxation requirement. Now, a hot technique right now that's been pitched in a lot of estate planning circles is maybe selling an asset to a non-grantor trust and then receiving installments back over time. And the reason you might do that is that the trust itself gets a stepped up basis from the sale in the asset, and then the trust could turn around and sell the asset, and then you could defer your gain on the sale over time, which wouldn't have been possible in a usual type of transaction potentially. But the big picture is that up front with the sale, there would be income to the grantor in the form of gain because there's a sale to the trust. So the question is whether the gain on the sale could be spread out over each installment or whether it must be recognized in full, because the trust isn't a random third party at arm's length. It's now, an entity created and potentially partially controlled by the grantor in this case. Well, first off, you need to really look to the type of asset being sold. If there's a sale of securities or inventory, you can't use this installment sale gain deferral anyway. But other properties like real estate could be eligible unless the real estate is in the form of like dealer type of inventory, like residential subdivision lots. Now, one thing to note is that the income of the property in the trust is generally going to be subject to higher income tax rates because the tax brackets for the non-grantor trust are much more highly compressed. And if you've depreciated the property over time, you cannot defer the depreciation recapture. So in essence, any positive difference from the basis and the gain that is attributable to depreciation will be taxed in full in the year of the sale. And it's also important to note that the treatment of the promissory note installment obligation must be taken into account. So if the grantor of the trust sells the note or pledges that note as collateral, it could cause some or all gain to be accelerated as well. We won't get into that, but we'll look at the bigger limitation on this as a strategy in that the gain deferral may be restricted to a certain extent when there is a sale to a related party. And in this case, the grantor and the trust are treated as related parties, as would be a beneficiary and a trust as well, if you wanted to try to get around it that way. But either way, the consequence of having a related party thrown in the mix in the form of a trust is that if the grantor sells the property to the trust, and then the trust turns around and sells that property within 2 years, the gain would be accelerated. And similarly, if you have a buyer lined up, the buyer can't just wait on the sidelines for 2 years because that 2 years could be suspended if the risk of ownership to the trust is diminished. So it's important not to have a deal on paper with a buyer just waiting in the wings if you enter into this type of transaction. And importantly as well, nobody's really sought a comfort ruling from the IRS yet on this type of transaction. So in order to really make this work, you have to really look at creative ways to get around the related party rules, especially if there's going to be a sale of the original asset within 2 years. And the biggest danger here is that you lose out on the deferral of gain, and the trust now, instead of the grantor, becomes subject to income tax on that gain at much higher rates. That's it for today's episode of the 10th of an hour. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening, and I look forward to seeing you in the next episode.